But right now, $15 or $57 per ounce of silver, $12,592 per ounce of gold. But that's just looking at dollars. What happened when the bond market busts? Remember Ecker's pyramid? Gold and silver at the bottom, the real value, everything on top is some sort of derivative. And when those derivatives start failing, where does that value go? It goes all the way down Ecker's pyramid to the bottom into gold and silver. Ladies and gentlemen, we're not looking at $15 or $57 silver per ounce or $12,592 gold per ounce. We're probably looking at quite a damn bit more when the derivatives and the debt bubbles burst. We don't even know if any amount of money will pry silver and gold out of strongholders' hands.
Welcome to Gold Silver Pros.
Hey everybody, there's your host, Rob Kientz of goldsilverpros.com. This is your Thursday, October 26th presentation, and we're going to talk about the collapsing debt markets. Yeah, they're collapsing like across the board, and it's starting to get pretty bad. So we've got a presentation for you to go through that, and then I've got some special deals for you on gold at the end of the presentation I think that you're going to like. But let's jump right into it. The title of the presentation are "The Debt Markets Are in Deep Trouble," and the data is horrific. And we haven't even gotten to the worst part of it yet. We're just at the beginning of the collapse. Well, let's take a look at where we are. First slide up, we're going to talk about the real estate markets. I want to give you a little bit of day before we get into the debt side of it. U.S. new home sales are actually up slightly, which is nice overall on the year, even though you can see them going down a little bit on the bottom half of the chart. But that is the smallest part of the residential real estate market. There are only about 760,000 home sales, according to SAR. The existing home sale slump is much bigger. You can see that there are millions of units that get bought and sold every month, and that has been cratering since February, since before the banks started crashing earlier this year, and has reached a cycle low this year. Year to date, they're down from over 4.7 million to about 3.95 million. That's about almost an 800,000 home drop in a year average every month. So that is about 10 times the size of what's going on in the new home sales. So as you can see, the overall home market is decreasing a lot. That's sales. That's new ones. Well, what about the existing ones, Rob? How are the existing ones doing? Do we have defaults? Do we have foreclosures? What's going on? Well, according to Yahoo Finance, foreclosure is never a good sign. Back in 2008 and 2009, it was a stark symbol of the Great Recession. This current data, and this is for August, this current data set shows a 7% increase from April, according to Yahoo, but twice that much from 2022, with 14% by comparison. However, taking into account all that foreclosures mean, analysts can use the data to predict specific real estate trends going forward. Well, what are those trends? Let's dive deeper into the data, ladies and gentlemen. Oh no, delinquent payments are rising again. The percentages of mortgages 30 to 89 days delinquent, national average, is up in March. Now in the second quarter, they fell a little bit again, but overall it is up after the downtrend since the Great Recession. So during the Great Recession in 2008, 2009, we peaked at over 4%. Now we're rising back towards 2%. We're not quite at 2%. But it's rising before we even call the next recession. Because, ladies and gentlemen, the GDP print today was something like 4.5%, or this week was 4.5%. So apparently GDP is doing great. Now, if you look at inflation, it's actually negative. Because why? Because inflation's over 5 or almost 5. Well, actually, if you believe real inflation from shadow stats, we're probably somewhere between 10 and 15%. But even the government's number, if you decrement GDP by inflation, you're right at zero. So we're not growing. But the delinquencies have risen already before we officially get a recession. What happens when we get into a recession? Well, you can see at the front part of this chart, they're going to double, more than double from what they are now. Like I said, we haven't gotten to the worst part of it. And I wanted to go over an example. Thank you to follower Scott for sending me information on Pennymac. I did some research further on what he said. And some of these slides are his, some are mine. Appreciate that. Always appreciate the listeners and followers leading me into data that I can use for presentations. So in 2023, this year overall, Pennymac is the second largest overall lender. They're a real estate lender. Now, overall, they're not the second biggest, but this year they've really accelerated, and they've been in business since the early aughts, early 2000s. Who is Pennymac? Well, according to a 2013 article, Pennymac, headed by former number 2 at Countrywide, files for IPO. So this is headed by a former Countrywide person, second in charge. Do we remember what happened to Countrywide back during the Great Recession? Did they go boom? Was that not a nuclear bomb in the mortgage market and the residential real estate market back then? I do believe it was. Well, they're back. Countrywide's not dead. They rebranded essentially as Pennymac, or at least as the same leadership team. And oh, look at their performance. The last few years, it's been down, and it's been down for quite some time, since 2022. But look at what happens, this big drop over on the left side of the chart in 2020. What happens to the performance of loan servicers and loan originators when the economy stops and people can't pay their bills? There is a plunge, ladies and gentlemen. The stock plunged by about 60% in 2020 during the quote-unquote pandemic. And that was a short-lived recession. We haven't even gotten into the recession yet, and Pennymac's already crashing, have been crashing for almost 2 years. Not looking good, especially with now in 2023, them being the second largest lender. Why are they lending so many loans if they're crashing? Well, let's take a deeper look at what's going on at Pennymac. They have had overall positive revenue the last few years, although the last year it's not. But they've had a lot of revenue misses. So the top chart, the one that has all the data on it, just look over on the right-hand side under revenue and forecast. They've been missing revenue forecasts for most, except for 2 of the last 2.5 years of data, or about 2 years of data. So 8 quarters, they've had 2 beats on revenues and 6 misses. Overall, if you look down here on the bottom, I copied this off of Yahoo Finance for Pennymac. The trust, their interest income after provisions for losses, which is the top part of this bottom graphic, is negative 135 million. Negative 135 million. So in other words, they have losses so that their interest income, or income they get from servicing, or the interest income they get from servicing the loans, is negative after they account for losses. And look at how many quarters it's been losing, 3 straight. This left number, the 135,508, is a trailing 12 months. So it's the last year's worth of data leading up to now. That's 4 quarters. It's negative 135. What about net income? Well, their net income for the last quarter was negative 73,287 million. Overall, the last 12 months, it's 101. But that's with the 73 million loss. So not only is their interest income falling, but the overall net income is falling as well. The business is failing, as they are the second largest lender in 2023. They're ramping up their lending, but they're taking bigger and bigger losses. Do you understand that trend? As they lend more, they take what? More losses after provision for losses on loans. Look at their income statement, balance sheet, and cash flow. The 2 that we're going to pay attention to are income statement and balance sheet. These are the 3 high-level statements investors look at first when looking at, hey, do we want to invest in a company? We want to invest in Pennymac? Well, let's see. Their gross profit, overall profit, trailing 12 months, according to Yahoo Finance, is negative $321.2 million. That doesn't look great. What about their total cash on the balance sheet? $267 million. They've actually lost more money in the last 12 months than they have left on the balance sheet in cash. Now, they do have other assets, but look at their current ratio. That's total current assets over total current liabilities, 0.7. They lack 30% of the money they need to satisfy current liabilities. Current liabilities. Look at total long-term debt, $11.14 billion. How are they going to pay off that total long-term debt when they only have $267 million in cash, only $250 million in cash, against $11.14 billion long-term debt, and they're negative on their current ratio? They don't have enough current assets to take care of current liabilities, much less the longer term ones. And what about total debt to equity? Well, it's blown out. Their debt, the amount of debt that they've taken on compared to the overall market value of their shares, 576.69%. Are you kidding me? 576% debt to equity ratio. They can't use stock to raise funds. The stock price has been falling. Let's go back to that chart. As the stock price falls and they take on more debt, while they continue to miss revenue estimates and go negative on net income. And when you're talking about net income or interest income after loan provisions is negative, none of these loans are performing. Okay, let me paint the picture. Second biggest lender in 2023, have loans since before that. The total overall losses the last 12 months, 321 million, which is more than the cash they have left over. So if they continue at the same pace for the next year, they're bankrupt in terms of cash. They may have to sell assets. They're going to be in serious trouble. They've got 11.14 billion in loans. The total debt to equity is mushrooming because their share price, they're cratering, right? And Pennymac is going to go bust before too long. Well, let's now get into credit card usage. That was an analysis of the mortgage market. Let's look at other debt markets because this is a whole debt presentation. We're talking about debt across the spectrum, not just real estate. What about credit usage? Well, according to Equifax and the New York Fed Consumer Credit Panel, total outstanding credit card balances 1999 to present were over $1 trillion. Over $1 trillion for the first time in the history of the United States in credit card balances. Back in 99, it was less than 500 billion. It's doubled. Now that was a slow increase because we had this decrease when? Right after the Great Recession, and people deleveraged, lost their jobs and everything. And either credit was written off or they paid it off because people couldn't take anymore. And then starting in about 13 to 14, we started that debt usage again. And then we had the pandemic and it came down and then boop, right back up. So you see, when you go in recessions, people use their credit card less because can't pay it off. And credit cards themselves get more restrictive on who they will issue credit cards to, and they raise rates during those times. But during the quote unquote good times, credit usage balloons and it's an all-time high. But what about credit card late payments? Well, according to the Fed, the delinquency rate on credit card loans for all commercial banks is at a 10-year high of almost 2.8%. It's at a 10-year high. Now, it's nowhere near where it was during the Great Recession, but it's at a 10-year high when we're at an all-time high in credit usage. What does that mean for the banks that are holding those credit card balances? Under tremendous pressure. Can you say that debt going bad? So it looks like the delinquent payments and foreclosures are up in the real estate market. Pennymac's a good example. We went through that. So the residential market is crashing. Sales are down, more delinquencies, more foreclosures. Second biggest lender in 2023 looks like it's about to go bust, which will probably leave a gigantic hole in the residential mortgage market, cause a lot of those mortgage-backed securities go to bust. A lot of those are used in what? The repo market, the liquidity market. Credit usage is up at an all-time high and delinquencies are rising to a 10-year high. That's not good. Well, what about, the world bond markets? I took a look at the Vanguard Total World Bond ETF, which seeks to emulate the bond returns of the major sovereign bond issuers across the world. And look, at its inception since 2018, it's almost even. It's returned a whopping 100th of 1% in the last 5 years. 100th of 1%. But look at that 3-year, down almost 5%. What about the last month? Down 2%. 3 month, down 2.4%. The world bond markets are an absolute free fall, and they have been for a few years. But that also includes the U.S. because what's happened in the U.S. in the last couple of years, rates have been rising. Why? Well, the Fed raised their rate, and also the worry of the world about the quality of U.S. treasuries has been falling as we head into what looks like a really nasty recession. So bond rates are rising. The 2-year and the 10-year are both rising over 5%. Not good. World bond markets are crashing across the world. This is bad. That's another debt market. What about student loans? Well, we reported on that about a month and a half ago. It says here, according to Credit Karma, federal student loan borrowers struggling to make ends meet before payment resume in October. Listen to these statistics. Remember, there are $1.5 trillion in student loans, and more than 2 in 5, or 45% of that 1.5 trillion, those borrowers expect to go delinquent on their student loan payments once forbearance ends. Guess what? It ended. They now have to start paying them back. And even though, according to Credit Karma, they have not been making student loan payments, 53% of federal student loan borrowers say they are struggling to pay other bills, auto loans, mortgage, credit cards. What did we just go over? We went over all that other stuff. They can't pay that. And now they're going to add 1.5 trillion student loans on top. Are they going to pay that? No. Is it going to be 45% of loans go delinquent? I think it's going to be higher because all these other debt markets are busting. And more than 2 in 5, 44% federal student loan borrowers do not think the return on investment for higher education is worth the expense. So what's likely to happen when they have to pay those back? If the juice is not worth the squeeze, they ain't paying them back. Why would you? If you're not making enough money to pay your other debt, and you took basket weaving in college, or even took maybe a more useful degree, and you still can't find a job through no fault of your own because the economy sucks, because the older workers are not moving off of the roles and into retirement because they can't. And so the new guys can't get the jobs as the older people retire because they're not actually retiring, they're still working, and they have more experience and they're willing to take less. You're not going to hire somebody who's 22 years old. If you got somebody that's 55, who can do the work 5 times as efficiently for the same price or less. And those people are keeping their, baby boomers aren't retiring, they're keeping their jobs because they can't retire. I talked about that in previous videos. What are the conclusions? Well, according to the U.S. debt clock, the dollar to silver ratio is 1,557 per ounce now. It's going down to 1120. Why? Because dollars are being destroyed. Well, that's domestically printed dollars. Doesn't include all of the worldwide amount of dollars. So this is actually not correct when you look at it holistically, but just what's in the U.S. Dollars are being destroyed right now. Why? We're in a deflationary economic environment. Loans are going down. Dollars get destroyed when loans go down. But right now, $1,557 per ounce of silver, $12,592 per ounce of gold. But that's just looking at dollars. What happened when the bond market busts? Remember Exter's pyramid? Gold and silver at the bottom, the real value, everything on top is some sort of derivative. And when those derivatives start failing, where does that value go? It goes all the way down Exter's pyramid to the bottom into gold and silver. Ladies and gentlemen, we're not looking at $1,557 silver per ounce or $12,592 gold per ounce. We're probably looking at quite a damn bit more when the derivatives and the debt bubbles burst. We don't even know if any amount of money will pry silver and gold out of strongholders' hands. Now, some people will have to sell because they have to pay bills. They're going to have to pay mortgages. They're going to have to buy food. So yes, there will be an increased amount of gold and silver flowing, but at much, much, much higher price, much higher prices than they're at right now. And I think that's what's going to happen. And on Twitter today, I posted a chart. It's not here in this presentation, but go to Twitter. And I posted a chart of how the U.S. stock market indices are now rolling over. They've been rolling over since July, all 4 of the major ones: NASDAQ, S&P, Dow Jones, and Russell. The Russell, which is a small cap index, is net negative on the year, and so is Dow Jones. Dow Jones was down, I think, on the year today in the morning, 1.02% on the year to date. And the Russell was much worse than that. I think it was 5 or 6%. It's completely crashing. Well, who creates all the jobs in the economy? Well, it's small businesses. So if those are crashing right now, are we going to have a lot of new jobs coming? No. This may be the last really positive GDP print we get in a long time. And I'm not even sure I believe those numbers. I don't believe the numbers the government puts out on GDP or on anything. I covered that about 14 years ago in my book called Trap Show, The Truth About the Economy. And if you want a copy of that book, it's 14 years old, 13 years old, released in 2010. You can go get it on Amazon. I have it for cost. I don't make anything on those book sales. It's just because it's older. But go look at the book and go look at what I talked about. And read chapter 2, the most valuable chapter in the book. I talk about why the government numbers are wrong. 50 pages, I go over it. Really long detail. And so I don't believe the GDP numbers now. I don't believe we have a net positive GDP. I think we're already in a recession. But if you go by the official numbers, we're in a recession. Now, if you decrement that for inflation, we're probably sitting just above zero. How long does that last, given all of these things we talked about in the presentation today? If the debt markets are rolling over, we're in deep crap because the derivatives are built on those debt markets, on the paper markets. And the derivatives go, you've got $1 trillion, or I'm sorry, $1 quadrillion that's going to go boom. Multiple trillions of US debt, multiple trillions of foreign debt, the derivatives piled on top of that, leveraged investments. You're going to see $1 quadrillion in multiple currencies go boom. And what happens to the price of silver and gold then? It may be limit straight up. It may be you can't buy it with anything unless you barter for me for pigs for bacon, hens for eggs, medicine, guns if you feel like you need that, clothing, services, fix my teeth, dentist, help me out with my my pneumonia doc, something like that. But it's not going to be tradable with paper currency. So these numbers, I think, are really low. All right, on to the special for the week. I told you I would have a sale on gold, and I do. I'm putting all of my Kinesis stuff on sale. I'm a distributor for Kinesis, one of the very few in the United States. These are great bars, however. They come in mint packs. They come in assay cases. They are great. I have some in store, and I have more that I can get for you very, very quickly. We can have it drop shipped to you. The 1 ounce Kinesis gold bars right now are for $75 over spot, which at the time of this recording, which is about 2:34 Central Time in the afternoon, gold's trading about 1982. So $75 over spot is what, about 2060, 2055, 2060? That's not bad at all. It's a lot cheaper than you're going to get most online spots. We'll hold that $75 over spot regardless of where gold goes for this week. We also, if you can't afford that, but you want to get a little bit of gold, they have 10 gram, 5 gram, 1 gram bars. They're also for sale. You can get those at www.goldsilverpros.com. Now, if you want to get anything in bulk and get further discounts and get lower discounts, I will do that for you. Go to the website and click on volume pricing. Click the button to fill out the form. You just give me my phone number, and your email, and I will give you a call back or an email back. And we will talk about what you want, and I'll get you further discounts. If you're going to buy in any amount of bulk, at least 2 ounces, I will get lower prices. I will cut my profit as much as I can, get it out to you. And if you buy at least 2 ounces worth of any of these denominations, I'll give you free shipping and insurance. So that will allow you to get gold as cheaply as possible. It's a good way to do it. A lot of the sovereign coins went into shortages last week. A lot of those are starting to come back on shelves as we get more in, but the prices are much higher. Why? Because of what's going on with the regional wars. Those sovereign coins are more expensive. These bars are great. They're fantastic. This is a great company, and this is a great way to get gold inexpensively. And references for those guys that are interested are up on screen. Those aren't all the references, but the major ones that I used in the presentation. I'll leave that up for just a moment. What are you doing, ladies and gentlemen? The stock markets are rolling over. The world debt markets and the U.S. debt markets look like they're in free fall right now into a collapse scenario. We did have positive GDP print, but when you subtract inflation, it's not much. And it may be the last one. We may get one more. I don't see how we go past it. People are defaulting. And when they default and companies don't get paid back, you're not going to have a positive GDP. You're going to see it go negative. We looked at Pennymac here. Okay, we looked at Pennymac, the second largest lender this year in real estate loans. They're collapsing. Does that mean we're going to have positive GDP? What happens to tech sector? Tech sector is starting to roll over. I saw an article that $4 trillion was lost in the tech sector in the last calendar year in terms of stock valuations overall. Was it 4 trillion or 2 trillion? I have to go back and look at that. Don't quote me, but it's multiple trillions. But in the last few months, it's been $0.5 trillion of loss in the tech market. Have you been paying attention to NASDAQ in the tech market? It's not good. The losses are astounding, but it's led by the small caps. Now, the small caps do well when you get into the later stages of the recession because those are the first companies to recover and to grow. But when they start to turn negative, and the Dow Jones is now turning negative, what is a Dow Jones Industrial? That's manufacturing, that's industrial supply, that type of thing. Okay, smaller part of our economy, but very important part of our economy. That's a recession indicator. And the S&P and the NASDAQ are both trending down since July. Second half of the year, all the stock market's trending down. That's a leading indicator for what you're going to see in GDP the next quarter. So I don't think we're going to see a big GDP number next quarter. And when you decrement it for inflation anyway, even the stated inflation is just above zero, and you decrement it for real inflation, go to shadow stats or any real inflation measure. And we've been negative for a while. We've already been in a recession. Now, there are some good jobs out there, but the job losses are mounting. We have not recovered since 2008. Job levels were at 62.8%. Labor force participation rate, and I believe we were at 66% before the Great Recession in 2008. With all that money printing and all that debt issuance, we never got out of it. And guess what? In addition, we're now in multiple war fronts. What are we spending? $110 billion? What are we at? $34 trillion in total debt in the U.S.? It's unprecedented in history. We're in trouble. What are you going to have? In my opinion, gold, silver. I'm not your financial advisor. You have to do your own research. That's my disclaimer I use in every video. For your own personal situation. This is for research and education purposes, but it looks like to me, stock market's turning down, debt market's about to go in a free fall collapse, not only in the US, but it looks like across the world as measured by those bond indices. Bond rates are rising, not good. Does not look good, ladies and gentlemen. Does not look good. Anyway, that's going to do it for Thursday. Thank you guys for paying so much attention to the channel. We appreciate it. We try to bring you the best educational research we can in the macroeconomy and in gold and silver and in other things. We cover a lot of things on the channel, but we really focus on gold, silver, and macro to tell you where things are going. And we're usually ahead of what most people, because I do research into the future and I do some prognostication. So come here if you want to know what's going to happen next 3, 6 months, a year, that type of thing. Now, I've been saying since 2018, I thought that we'd probably go into a recession by 2024, 2025. The deep one, the big one, the big one, where we have potentially a currency collapse, hyperinflation, that type of thing. Now, is that going to actually happen? I don't know. It's really hard to date these things, but if you look at all the milestones, we're at the front end of what looks like a free fall collapse to me. What looks like the destruction of the US dollar, and what looks like the rise of gold in your international banking system. Basel III, we talked about that last year. I think we did 4 videos on it, Basel III, and the use of gold as a high quality liquid asset in the banking system. The banks have been buying gold hand and fist since 2010, 2011, after the last Great Recession, because they knew what was coming. They're getting into high quality liquid assets, HQLA. Look at the Basel III documents. Free fall collapse, money moving back into gold. What do you want to be in? It's up to you, but look at the research. All right, thanks guys. Until next time, Rob Kientz, goldsilverpros.com.